Welcome to It's the Economy. It's a magnificent set of numbers that we are going to analyze today. For the first time in 11 quarters, India has posted a current account surplus. Now, we must absorb the significance of what this means. About 33 years ago, India had only enough dollars to pay for 3 weeks of oil imports. That's when the IMF threatened to make India a defaulter and the great liberalization was ushered in. Even 11 years ago, in 2013, Indian rupee was classified as one of the fragile five. Why? Because the year before, we had a current account deficit of about 5.2% of GDP. So the rupee has always been under pressure because we import much more than we export. But this year, or rather in the quarter Jan-March 2024, we have reported a current account surplus. Now, what has generated this huge difference is our improvement in our services exports. Software services, only software services have risen by about 9% to $142 billion. There is a new category called business process exports. That's largely this, the non-software part of the GCCs, the Global Captive Centers. That has generated inflow of $29 billion. That's a 40% jump over the year-ago number. And then there are Indians living abroad and sending money in. The Indian diaspora has expanded, so have the remittances. And we have a huge $106 billion or $105 billion coming on account of this. That explains the current account surplus. But current account surplus also means that India is sending savings abroad. A deficit means investments flow in. A surplus means India is exporting its domestic savings. So is a huge surplus very good? How do we balance the two? What can it mean on the rupee? Are all questions that are thrown up. Too much of a good thing is also bad. For all these questions, I'm joined by two economists, Anubhuti Sahay, the head of South Asia Economic Research at Standard Chartered Bank, and Aditi Nayar, the chief economist at ICRA Ratings. Ladies, thank you very much. It's a great set of data to discuss, and I'm glad that we three women are discussing it. First to you, Aditi. The first question really is, does this start a period of very stable current account for India? There were times when we used to have a 3% deficit and it used to keep the rupee jittery. Is that period completely over?
Thanks, Latha. Well, certainly this is a really good set of numbers, better than what we were expecting. We had penciled in a small surplus and this has exceeded our expectations. One thing I would like to say is that it's possibly going to be transient. We are expecting the current account to revert back into very modest deficits from Q1 onward. So nothing to worry about. In fact, the size of the deficits is likely to be quite limited, 1 to 1.2% of GDP for FY25 as a whole. So overall, we do think that the current account situation is going to be a big part of the macro stability that we're envisioning for India going forward. I would say that, with the current account deficit, we do tend to see a lot of seasonality. So between one quarter and the next, the trends do tend to change quite a lot. So surplus in one quarter is not indicative of surplus going ahead. We do think we're going to slip back into a deficit of around 1.5% of GDP in the current quarter. The trade deficit for April-May has been fairly a fair bit larger than what we saw in April-May of last year. And that's partly on commodity prices being higher in this period as compared to the year-ago level. So while we are expecting this surplus to be transient, overall, we feel that the current account situation is very, very comfortable and is going to be a big part of India's macro stability going forward.
Okay. No, I take your point that fourth quarter is seasonal. Our exports normally do well because people are meeting deadlines, meeting targets, and we historically have been stronger in the fourth quarter. But Anubhuti, the same question to you, slightly tweaked. Yes, even the full year is a deficit actually, but it's only a deficit of 0.7%. That also is a historic low. We have normally averaged 2.5–3%. Can we at least say that going forward, India on a stable, sustainable basis will post a current account deficit at best of 1%, not more?
Yes, Latha, what you're pointing out is a very important structural change, which we can clearly call out for. So current account deficit, as you very rightly mentioned, used to be wide and extremely vulnerable to higher crude oil prices. With doubling of services exports, we have clearly seen a structural change in current account deficit story. And if I just break it down, just to give us a sense on how much financing requirements are there on an annual basis, effectively our goods trade deficit gets completely funded by our services trade deficit and remittances. What is left to be funded is simply the payment which we have to make in terms of investments made in the debt segment or the equity segment. So, all the royalties, interest payments, dividends, etc. So that is the only portion which needs to be funded. So I would, definitely make this point strongly that the current account story has clearly seen a structural change, and from a thumb rule of where it is said that 2% of current account deficit is sustainable, probably it will require oil prices to be extremely high to go to that level. Closer to 1% is the more likely scenario which we will see over next few years.
Okay. Well, actually, I know that Reserve Bank governors have in the past shared that for them, it was a Lakshman Rekha not to cross 2.5%, because over 2.5% current account deficit to GDP, the pressures felt on the currency. But clearly at 1%, it becomes a non-problem going forward, as both of you ladies say. But Anubhuti, what about the rupee? Today itself, obviously, there isn't much movement because this is March data that we are getting, and that is priced in. But does this make for a stronger rupee going forward? What are your levels?
So in terms of our forecast, Latha, we are calling for 82.70 by end of 2024. So a little bit of strength coming from the current levels. Having said that, in India, current account deficit is a story which will persist. So any appreciation in our view is primarily driven by a temporary phase of, say, dollar weakness. We do not expect rupee to remain on a stronger footing on a medium-term basis. So I think if I have to draw a parallel to what happened in the last decade vis-a-vis what we expect this decade, if it was an expectation that rupee would depreciate by 2.5% to 3% on an annual basis, I think that range has clearly shifted lower by 100 basis points because of the structural change in the current account deficit story. Okay. So near term, by end of December, we might see a temporary period of rupee appreciation, primarily driven by dollar weakness when Fed starts cutting rate. But as we are a twin deficit economy, highly vulnerable to commodity prices, the depreciation pressure will remain, but it will be at a much slower pace than what we saw in the last decade.
That's a big headline. If we were normally experiencing a 3 to 4% currency depreciation per year, and if that falls by 1 percentage point or falls to 1%, that's a significant change in terms of our risk-taking ability, our rating, etc. Aditi, would you agree, one, that we are in for a much slower depreciation, and two, will the Reserve Bank be the counterweight? You don't want an appreciation or a slower depreciation. You want a depreciation to beat the Chinese depreciation, to retain the advantage of the domestic economy, not getting flooded by cheap Chinese imports. So, two questions, track of the rupee and whether Reserve Bank will prevent the slower depreciation.
So, Latha, I'll offer you a few thoughts on these topics. First of all, as far as the rupee is concerned, in many periods, we haven't seen this average depreciation taking place every year. We've seen a movement in a narrow range, so a modest sort of a tendency to mildly depreciate. And then some event happens, either domestic or external, and you see a large step change coming through in the rupee. So firstly, this average, steady depreciation is something that we haven't seen in a long period of time. Yeah. So step changes, what will trigger the next step change? I think that is something that, maybe it will be geopolitics in the current context, not necessarily a domestic reason that could lead to a step change in the rupee dollar exchange rate. Secondly, I mean, if we look at our inflation differentials, certainly those now hopefully are going to be much narrower than what they've been in the past. So that that supports what Anubhuti is saying as well, that even if we look at an average depreciation over a much longer period of time, it should be narrower than what we've been used to in the past, simply because inflation differentials should be much lower with the advanced economies than what we've had to deal with in the past. I would imagine that the RBI possibly will prefer to look at a more stable rupee. So, not too much appreciation and not too much depreciation. That's what we're expecting over the next few months.
Okay. Well, a current account deficit, a current account surplus represents domestic savings going out. That's not healthy at our stage of growth. We are still, 120th in terms of per capita income at about $2,600 per capita. So do you think, Aditi, that the policy will have to work very hard to ensure that we have enough imports and our industry is able to absorb it? Should it become one of the policy focus to ensure we don't have a current account surplus?
So I don't think the current account surplus is here to stay. And certainly what has led to this, great deal of comfort that we got in the last few quarters on the current account side has been the inflows coming in from the services trade surplus, a lot of which is benefiting from the GCCs. And GCCs not only the earning us for an income, they're also creating a lot of jobs. So I think policy focus should be to support GCCs and make sure they flourish, because they help us with our jobs question as well.
Anubhuti, what's your take? Would you say that since we have an impending surplus, or at least balance, not really surplus, should policy work very hard to ensure that we are able to absorb more imports? This is the best time we have under the sun, when the demographic dividend is kicking in, when tax to GDP is rising. Should there be a bigger effort to import more and ensure our industry is able to absorb it?
Latha, I think if we look at the whole focus of the government's policy, it is primarily focused on boosting the manufacturing sector. So when the push is to increase the medium-term growth prospects, I think an increase in imports will automatically happen. Not because the government wants the imports to be high, it's just because the government is focused on boosting the medium-term potential. There will be counters to it, which can keep our current account deficit story on a more stable footing, or at a level which doesn't put our macro stability under risk. The counter, as Aditi was pointing out, one is the services exports. India has clearly established itself in terms of GCC capability. And the other part is on FDI. I think this is one point which probably we are missing out when we are focused on the lot of positive news around the current account deficit story, is FDI has been slowing. If you look at the past 5 years, the first 3 years, the net FDI flow was closer to $40 billion. Then it came to $30 billion, and we are now down to $10 billion on net FDI for FY24. Current account deficit to FDI is a very, very important metric when you are looking at macro stability and also when you're looking at rupee stability. If the current account deficit gets fully funded by FDI, that provides a lot of comfort to the central bank, that the reliance on less durable flows, that is portfolio investment, is not very high. Right now, I think even if we are at a $23-25 billion of current account deficit, it's giving us a lot of comfort. The FDI flows are not there. And our view is that probably when the interest rates globally move lower, this can emerge as a counter. Even if the current account deficit widens to some extent on increased imports, we can see some counter coming from the increased FDI inflows over a year and a half away from here onwards.
Absolutely. Anubhuti, I think that's a brilliant point, and we were actually flashing that data as well. One of the points I was making in terms of India not able to absorb imports, India's growth is wanting when the opportunity is coming knocking, is proven also by the fact that we have not been able to attract as much FDI as we should be in our stage of growth. As you pointed out, FDI this FY24 is 1/3 of what it was the year before, when it was $28 billion. So just a final point, Aditi, would you say that we are moving to a structurally different situation where the current account deficit may be there, but it will no longer be a binding constraint?
I do think so. I think we're in for an extended period where the current account deficit is going to, at worst, be 1.5 to 2% of GDP. And that also only if commodity prices skyrocket, perhaps because of geopolitical or other issues. I don't think the global growth outlook is going to be supportive of commodity prices being so high on a sustained basis that we get into a current account deficit at those levels. So I do think that structurally we're in for a very, comfortable period as far as our current account deficit is concerned.
All right. Ladies, thank you very much. There is, of course, the other big event that is upon us. On Friday, India enters the GBI EM bond index, and that will mean a regular flow of at least 2 billion into the Indian market by way of capital investments. So this is going to be a very important and a very liberating period in terms of India's external account, very far from the fragile five that we were just 11 years ago. So on that celebratory note, thank you very much, Anubhuti and Aditi. That's it on this edition of It's the Economy. Thanks for watching. Chartbusters coming up.